Good morning, I'm Steve Wilson. I'm Director at Rothmere Wilson Chartered Financial Planners, and this morning I've got with me James Sullivan, who is the Co-Manager of the Miton Asset Management Strategic and Special Situations Funds. These are core holdings in the Rothmere Wilson balanced and cautious portfolios, and they follow a multi-asset strategy, so they're investing not just in equities but across the board in cash, currencies, bonds and debt, as well as equities. They have an excellent long-term track record of high returns and low volatility. So, welcome James.
Thank you.
Could you tell me a little bit about your experience as an investment manager?
I began my investment career in 1999 when I joined a regional law firm that had an in-house private client stockbroking division. So that was some 12 years ago now, it will be in the autumn. And I think that gave me a great foundation knowledge of investing, and it certainly gave me an appreciation of dealing with private clients, and it served me well in my transition to fund management, because not only now am I one link detached from the end user or the beneficiary of our products, I think I still appreciate the value of the wealth that we are actually managing. We must never lose sight of the fact that we are only the custodians of other people's wealth. And I remember being told once that an investor should only invest what he or she can actually afford to lose, which in reality is utter nonsense, because we're not gamblers, we are long-term investors.
That's interesting. So tell me what you consider to be your investment style then, James.
Our investment style is very much big picture investing, so we try and get the top-down positioning of the portfolio right from day one. So to us the starting point is all about the macro backdrop. What is the world we're in today? And then we obviously look to populate those themes with stocks and assets, and in that approach we're very flexible, and by that I mean that we can invest in any asset class that is available to us, whether it be bonds, cash, equities, commodities, gold. And what we find ourselves doing is quite often trying to sell the expensive asset classes and buy the cheap ones, which at times can be non-consensual, because quite often they're cheap because the rest of the market is buying the expensive assets. And that can sometimes lead to periods of underperformance, relative performance to the market. So for that reason we can be considered non-consensual. But if you have a look at the performance since launch, which is some 14-15 years ago now, that style of management has been very rewarding indeed. And I think caution is always at the forefront of my mind, and what are the risks involved, and it's very much a consideration ahead of what is the reward on offer. We want to return capital to investors without taking undue risk.
So, I mean, with that, what are the sort of the key benefits as you see, and some of the problems that you have to deal with from that style?
I think certainly the biggest benefit, without going back to my private client stockbroking career, is that I learnt that many clients, and I hear this from IFAs and wealth managers also today, many clients are not so concerned with what the sector or the benchmark is doing or what the equity markets are doing. All they want to do at the end of the day is to beat inflation, and certainly beat the rate they can get on deposit. Periods of relative underperformance to us as managers, it doesn't matter. We know why we're investing in certain assets, as I say, because of the macro backdrop. But occasionally, if you are behind the market for a sustained period in time, there is an element of supporters who begin to lose patience, because they want to achieve the gains that are on offer by leveraged commodities or emerging markets at all times. And in our industry it's not always possible to have your cake and eat it. And it was the great economist John Maynard Keynes who made the point about markets remaining irrational much longer than you can remain solvent. And it's not quite the point I'm making here, but the point I am making is that there are times during the investment cycle when equity markets become detached from reality, and that's certainly something we believe we've witnessed in the past 2 years.
So when you've got a view, how do you go about challenging or testing that view to make sure you're on the right, you think you're on the right track?
It's always a challenge to agree with a view that contradicts the setup of the portfolio, whether it be from an asset allocation perspective or a stock specific call. but we read an awful lot of literature, whether it be economic data or independent publications, and some of it complements the portfolio positioning and some of it contradicts the portfolio positioning. And it's at times like this it's important to say to yourself, if I were starting again today with a blank sheet of paper, how would the portfolio look? And you do have to do that on a regular basis to ensure that positions are not getting stale. And it's sometimes too easy to become emotionally attached to a stock or an asset allocation. And one of the most important things is never to get hung up on what you paid for the stock. You forget about what the stock cost you or what that asset class cost you to put into the portfolio. You have to make a decision whether it remains today a sound investment.
So what's gone particularly well and not so well recently in your portfolio?
We always try and maintain a low level of volatility because I believe that is what the client wants. They don't want to ride through every bump in the road. So the portfolio has had a very low volatility, certainly much lower than the average managed fund for some time. One could argue that that is what you'd expect with a defensively positioned fund. So be it, but I still perceive low volatility as a positive. The sovereign debt positions we have in the portfolio were tremendous for us in 2008 when there was a significant sell-off in equity markets. We've held on to many of those positions and they have added modest value ever since. Okay, not in line with equity markets, but they have also, they have still contributed a positive return to the portfolio. Some of our lower risk Asian trades, we are not in high risk emerging markets at the moment. We have been historically, but we're not at the moment. Our low risk Asian trades at the moment include bonds and currencies, and they have added double digit returns over the last 18 months. So if we can get double digit returns on a lower risk investment, then we're quite happy to collect that in this environment. What we've also started to see is a rotation in the equity markets from the growth stocks into the defensive stocks, and that's been terrific for our portfolio because we own the defensive stocks. So the defensive stocks are being re-rated and therefore the valuations are going higher. So that's been a terrific short-term kicker for the portfolio. On the point you make about the negatives, I think it would be fair to argue that the overall asset allocation of the portfolio has been far too defensive for the past 2 years. There's no doubt about that when you have a look at what equity markets have done. And primarily that's because we were caught out by the power and the impact that QE coupled with emergency interest rates had on equity markets and risk assets in general, commodities and so forth.
That's quantitative easing or
exactly.
Printing money.
Absolutely. And it created this inflationary scare, and in turn it created this huge appetite for risk assets of all sorts. And unfortunately we missed the lion's share of that trade. So relatively speaking, we missed out.
So at the moment, what any particular areas of interest you've got at the moment, or are there any specific buys or sells you're looking at the moment that you can tell us about?
The most recent update to the portfolio from a bottom-up perspective in terms of what we're actually buying and selling within the portfolio has been a collection of some very large cap FTSE 100 names. And we've been doing that via a variety of sources, so we can buy directly, but quite often we prefer to buy via collectives, so you get the assurance of diversification. And we've been buying via Mark Barnett, who runs the Invesco UK Strategic Income Fund. And he shares the same views as us, that at the moment the value within the equity markets is very much in the large cap names with strong dividend policies and sustainable dividends, sustainable yield. And that's very much where we're seeing value. So we can afford to introduce one or two equity positions, as I say, against a relatively defensive portfolio. If we have a look at cash on balance sheets of these companies, it's as high as it's been for a number of years. Yes, okay, the debt is also high, but the cash on the balance sheets will be returned to shareholders via one form or another, whether it be via M&A activity, research and development, management buybacks or increased dividend payouts. It will find its way back to shareholders, and I think the increased dividend payout will be the route many companies take, and I think strong dividends will be the driver of investment returns probably for the next 2 to 3 years if you are exposed to equity markets. On the sell side, we've been quite static because we haven't felt forced or panicked into selling down our defensive assets and rotating them yet into risk assets, coupled with being in a privileged position whereby we're receiving inflows from supporters like yourself. We are not being forced to sell down assets to meet redemptions. But if equity markets or risk assets maintain the current volatility and weaken, we will start to rotate more aggressively out of defensive assets into those risk assets I spoke about.
So James, that's interesting to hear some of your short-term movements at the moment, but what's your more strategic long-term view?
Well, I think longer term, clearly now we are in a period of credit contraction and deleveraging, and I think that is to continue for the next half a decade, if you like, the next sort of 4 to 5 years at least, as investors and households and businesses pay down debt. And that is going to keep a lid on economic expansion within the UK, that's for sure. And that is one of the reasons why we believe interest rates in the UK will be at so-called emergency levels for some time. There might be 1 or 2 token rate rises along the way, but I do not see rates being above 1.5–2% for the next 3 to 5 years. If we have a look at the unemployment data, we're almost at 10% unemployment in the UK, and I think we have to get used to that. I think unemployment will come down, but I think we have to get used to an unemployment rate of around 7 to 8%. I think that will become the new normal. And if we turn our attentions to the inflation debate, again, although the RPI numbers, the inflationary figures that are coming through, are higher than perhaps we are comfortable with, particularly with base rate being at 0.5%, the inflationary tailwinds that we're witnessing at the moment, taxation, weak sterling, and commodity prices, and energy prices generally being very high, I think those 3 tailwinds are very much temporary factors. And once they've washed through the system, there's very little domestic inflation. There's no wage inflation in the UK, no real wage inflation in the UK. So therefore, I do not believe that Western inflation is sustainable. So the general theme of the portfolio from this point and going forward is very much to favour the East over the West. We're looking certainly outside of the UK borders. We're very conservative on the outlook for the UK economy. And if we turn our attentions, of course, to the Eurozone, that's a very interesting talking point at this moment. And the markets have bounced quite aggressively in the past 2 or 3 weeks over the latest proposal to bail out the Greek economy, or rather to reduce the short-term funding pressures on the Greeks. And the proposal is that half of the maturity proceeds in 2011-2012 will be rolled back into 30-year-old Greek bonds. And that's been proposed by the commercial banks, but of course the commercial banks only own about 1/4 of the outstanding Greek debt, so it needs much wider support before implementation. So we mustn't get ahead of ourselves. The whole situation is to be resolved overnight. But the biggest fear really is not necessarily the issues Greece has, but actually the contagion of the debt across the Eurozone and the cross-border debt. Who owns what? And I think until we have clarification on that, I think it's a big question mark hanging over the Eurozone future.
So how would you summarise your current thinking on investments then?
Well, without wishing to repeat too much of what I've talked about, we're clearly very defensively positioned at the moment. But that doesn't mean we are not seeing opportunities. It just means we're not having to pay up for risk assets. We can see opportunities in lower risk assets such as the fixed interest markets and the currency market, and as I alluded to, some of the bigger names in the equity space.
Thank you very much indeed, James. I hope you found that interesting, and there's more information on both multi-asset investing and our portfolio performance on the website, which is www.rothmerewilson.co.uk. Thank you.